the summer the bull case was, Fed's going to pivot. Well, they just took that off the table.
Welcome to Wealthion. I'm Wealthion founder Adam Taggart. Thanks for joining us for part 2 of our interview with technical analyst Sven Henrich. If you haven't yet watched part 1 of our discussion with Sven, in which he details out why both the macro fundamentals and the market technicals both suggest a downward resumption of the bear market to new lows, head over to our channel at youtube.com/Wealthion and watch it there first. It sets the context for the investment themes we discuss in this video. Sven also shares the strategies he recommends for investors to follow to successfully protect capital through the rough ride he sees ahead, so be sure to stick around for that. Okay, let's get started watching part 2 of our interview with Sven Henrich. Let's actually start kind of from the technical side, which is at a high level, as you look at the current technicals, and are addressing the question, okay, does it look like we are still in a bear market? Was this rally that we just saw, not a breakout, but really just a relief rally within a larger bear market? Is that the case? If so, how much lower do you think this thing could go? What are the technicals telling you right now?
Okay, so in mid-June, when I made that bear market rally case for the technical reconnects, I said very clearly, you do not have a confirmed new bull market until you're back solidly and sustained above the 200 MA on the daily and the weekly 50 MA on the S&P, right? Just take those as a basic benchmark. In fact, today I put out a chart, which is also an interesting one. It's the monthly 20 MA on the S&P. You've seen many bottoms before, well, where the markets raced right back up, right? Especially during the intervention times between 2008 and 2020. And what you see in those bottoms is, it may drop below the monthly 20 MA and then races back above it. And then on the pullback, it tests it as support and then goes back higher. That's kind of a clear signal to say the bottom is in. Okay. In big bear market rallies, big extended bear market rallies, 2000, 2008, what we've seen on all of these 3 indicators I just mentioned, you get this initial first flush that takes place maybe over a few months, and you get extremely oversold. And then you have that counter bear market rally. And then these previous support points all of a sudden show themselves to be resistance. The market fails to recapture them. So when people say, in August, I saw, bull market is back. I said, no, it's not confirmed back until you get over these levels and can defend them. You can have poke overs. And we just had a poke over in August on the monthly 20 MA, which was 42.50. And we went to 43.20 or something like this, right? So we had a poke over, but it's a monthly chart. And guess what? We just dropped hard. And now you're looking, and the month is not over, so I'm not making any predictions here yet, but I'm saying for now, you're looking at a sizable monthly reversal candle, which is exactly what you saw in 2008, which is exactly what you see in 2000. So you got to look at this through a pivot of control. When do we know bulls are really in control? There was a signal chart I've been tracking with clients all summer long. It's NASDAQ new highs, new lows. And that one was actually stunning because it was as negative as we've seen it during 2008. It was just screaming red. And I was like, wow, what's happening here? Yet we're not really down. We're down 30%. Don't get me wrong. That was a sizable move. But in terms of where we were, it was still fairly high. But I'm looked at the signal and said, yeah, I'm not shorting this. I'm not. I'm going to get my face ripped off.
Yeah.
But what this chart showed, and this is really important, and I've tracked it, you can see it in 2015, 2016, you can see it in 2008. When it has these big negative readings, you get this counter rally to positive for just a short while. It kind of pokes into positive and over again. And guess what? That's just exactly what happened. Because I kept saying to clients, we want to see this positive. We want to see this positive, right? Because that's our sign to say, okay, now this bear market rally is played. And now you have the opportunity or the possibility that this could roll over. And guess what? August, it went right to positive and bang, it rolled over. So if that's the analog that plays, then it says, yes, we have a chance of a retest of the lows or new lows, right? So I think the next 4-6 weeks will tell us that. And of course, we got all these inflation reports, we got the Fed meeting, we got midterms, and we got the the QT quantitative tightening take place. So I think that's the negotiation phase right now. Now, if we get a rally that gets back above all these MAs that I mentioned, and it sustains that, bull market is back. Be absolutely clear. And I know that people will also look at the midterm seasonality chart for presidential elections. It's quite interesting, actually. It's played in general in terms of the directional pivots quite well. And it did call for a peak in mid-August. And guess what? We just had a peak in mid-August. It also calls for a little bounce into early September. But then it calls for new lows in later September. And then it calls for a big year-end rally. Now, everybody's on the big year-end rally thing, right? So I assume at some point around October, so people will try to take a crack at this. The question is obviously then in conjunction, what happens with all the lag effects we've been talking about, how's the economy evolving. So that, in my mind, the judgment is still out on that, and we don't want to jump the gun on this for sure at this stage.
Okay. Yeah. And this is, again, why looking at technicals is so important, because, I mean, as you describe that potential trajectory, I mean, I just can't think in my mind, what is a fundamental reason why we should have a big end of year rally in these markets when the economy is continuing to contract, and we're going to have the lag effect of all the, hit rate hikes and QT and,
Well, yeah, I mean, this is a fair question. What is the bull case from here? The sum of the bull case was, Fed's going to pivot. Well, they just took that off the table.
Exactly.
Right? Okay. So if the pause rates, well, maybe that'll give you a rally, but you still have the lag effects that are still going to go through. Are earnings improving? No. As the lag effects take hold, growth is going to continue to slow down. There's a recession in the UK. There's going to be a recession in Germany. You got all these little recession fires blurring up. So the Fed's not going to bail you out. The monetary supply is shrinking. So what is it? Maybe you get a relief on the dollar because the dollar is sky high, and so you may get a reversal on the dollar. Cool. But look at the 2-year. 2-year got to 3.47% today, new high for the year. I don't know if it can sustain. If it can reject, then yeah, that would maybe be positive for a rally. But why would it reject if the Fed is going to 3.84%, as they said they would?
Right.
And if you look historically as to where the 2-year is now, it's the highest level since 2007. Hello, folks. We ran up to 125% debt to GDP. We got 25% zombified companies. How is that a positive into next year for earnings, if it even doodles around between 3 and 3.5%? It's not. So yes, you can have relief rallies, but to have a fundamental argument for all of a sudden going back to new highs, I see people say, well, it's negative investor position. Okay, but that's not a fundamental argument. That's maybe a signal argument for a rally, But now that we have this new reality of restrictive monetary policy coming, please, I urge you all, rerun your equity valuation models. It's not there. And inflation rolling over is not if it is a good sign, but it's also, you got to understand the reason why it's rolling over, because everything's slowing down. So the only way you're going to get into new highs is just insane multiple expansion based on nothing.
Right. And as we said earlier, tied to the economy slowing down, those record high profit margins, they have to mean revert, right? Those earning estimates have to come down. Both of those things are obviously not good for stock prices. All right, well, let's zoom way back out here, and with both your macro and your technical goggles on, the stock markets were at all-time record highs right at the beginning of this year. As you look forward ahead the next year or two,
taking in mind everything that you just mentioned, where do you sort of see things going? You know, I'm assuming you think that the larger trajectory is downward. Correct me if that's wrong, but if so, what type of correction do we deserve here from the highs?
So I'm really terrible at making long-term predictions. Just simply because I'm not arrogant enough to presume how the future will unfold.
Yes, and your day-to-day expertise is looking at the technicals and saying this is what I think is going to happen in the near term, right? So,
if you look at past structural bear markets, 2000 to 2002, and of course 2008, 2009, or even before, there is actually a third possibility between new highs and new lows, and that is incredible chop for months on end. We saw that actually in 2000. If you look at a chart of the Dow in 2000, it was just, there were new lows and then there were massive rallies, and it just basically chopped in a larger range for 6 months. 6 months before actually then the recession took hold, and then new lows were ultimately coming. That's why I'm saying you don't want to be perma anything. I mean, if you really want to take advantage of the volatility, by the way, I'm just generally saying what a fantastic year this is, because as opposed to looking at 2-3 handle ranges on the S&P for 5 hours, as we did last summer, you actually have some really cool moves, and you can take them on the long, you can take them on the short side. It's not easy, but it's there. The opportunities are there. So I'm loving this year from that perspective. But to answer your question specifically, if the world is not flat and if it's not different this time, just go back to my basic market cap to GDP. Is the world different to some degree? Maybe, with all this technology and the concentration in the power of some organizations. But, don't even assume 50% or 75% market cap to GDP. Go back to a standard fully valued market, which is 100%. We're currently at 164%. Do the math on the S&P. Where would we end up if this is a structural bear market? Again, not a straight line. You can go to 2,500. Why not? Seriously, why not? Okay. If everything in the last 14 years got so exacerbated by permanent intervention and permanent liquidity and these ballooning balance sheets, if inflation does not come down back to 2% by Christmas, but will take a year or two, then yes, why not? And the Fed actually reducing its balance sheet back to something maybe more reasonable. Remember, they were down to 3.7 trillion by 2018. And then they moved it up a little bit in 2019. But it was between then and when COVID came in, they increased it in 2020 by 76%.
Yeah.
And then another 19% in 2021, 19% in 2021. Why? With inflation running high. And so far, they've been so brave and so bold to reduce it by 1.3%. Okay. So yeah, I mean, it would be painful, but go back to my housing chart earlier, or the chart I mentioned in terms of the housing supply. People are the younger generation is literally begging for a housing crash because they can't afford homes. So maybe it's actually a good thing to get a proper cleansing of the system, to actually get some more reasonable valuations that are commensurate with the salaries of people.
Is that what Emperor Sven would advise, which is we're just going to take the tough medicine now, let the system clear?
I was so happy when Powell said pain. I honestly say, I thought that was refreshing, because no central banker has had the guts to say it finally. He finally did. I hope he follows through on it. Our entire system has been built on pain prevention. That's really what it's been all about. And yeah. I don't want to see people hurting, but guess what? What we're seeing now is hurting people. It's the consequences of overdoing it. we're seeing people hurting because they don't see the opportunities to ever get ahead in this system. The problem with all this is they've exacerbated it all so terribly that I am fully cognizant. And of course, the people that are going to get hurt the most again are the ones that are first in line to lose their jobs. And
we haven't even talked about layoffs yet, but I'm assuming
no,
it
really sucks, and that's why I think this whole system is frankly rotten to the core, because again, the benefits are skewed to the very few, and it's the lower end of the spectrum that's getting absolutely hammered. I see this here in the UK. I mean, what's happening now with electricity prices, obviously Ofgem came out with an 80% increase in energy costs that's going to hit people in October. People can't afford this. Then we had a barbecue this weekend, and one of the guests was an elderly couple. He's almost 80 years old, and he's telling me a story and how he's trying to manage his electricity bill. He's getting a little oven where he's trying to use it only once a day or something. I mean, this is already happening in August.
Yeah, in August.
It's terrible. I don't have the answer. I don't have the answer. I just think they created this beast, and they have to take accountability for it and try to figure out how to noodle through this.
Yeah, and gosh, I'm tempted to bring you on again at some point and just talk about the social implications here. But you're right; they are terrible. I tend to at least focus a lot on the financial side of things first. But I mean, this winter in Europe, there very well may be populations that are having to deal with the fact that they don't have enough money to afford fuel to stay warm for the winter. And I'm already seeing headlines like what's going on in Poland right now, where these like multi-day lines outside of the coal mines, where people are trying to buy coal right now, where you may not actually even have the supply at any price. You might not be able to get the fuel that you need to heat your homes. We may have a winter where people are actually freezing to death in their homes, or at least in danger of such, which is almost sort of hard to imagine in today's modern age.
I mentioned anarchy at the outset. It's you can see this in England. There's actually a movement here in England now where people are saying, don't pay the energy bills, or basically say, well, you dispute the bill, which is going to put, the energy company on the process, right? So then they're going to be overwhelmed with bureaucratic processes to deal with the bills. No, people are angry. Absolutely, they're angry. And part of this is probably an own goal, right? Remember all the sanctions they were putting on Russia and Putin during the Ukraine war. That kind of backfired at this point because the war hasn't ended. Putin keeps going. What's the solution here?
Right. I've got that as a question I really wanted to dig in with you too. Before I do that, let me just ask the question that I've got to ask, which is, the people who are watching this channel, they are concerned, prudent investors. They're watching what's going on. They've listened to everything you've just said, and I'm sure it's dialed up their concern even more probably. Are there asset classes that you think are better suited, or asset classes or investing strategies that you think are better suited to this environment that we're heading into here? And are there asset classes that you wouldn't touch with a 10-foot pole in this type of environment?
Well, I mean, we're index traders, okay? So we don't focus on individual stocks. Look at Friday, for example. What was your safe haven on Friday? Nothing. I mean, literally everything went down, right? Plus 90% down day. That's the problem with these right sizing events. Gold hasn't done anything all year. Mm-hmm. If people were all bullish gold as a hedge, Bitcoin certainly hasn't worked either. And by the way, on Bitcoin, I put out a bullish article in January with a big caveat. I said it's down, but it's completely tied to the S&P, and I expect a bear market, so I expect downside. And my view was as a long-term 10-year, this is not Northman trader talking, this is Northman investor talking. Mm-hmm. I'm going to be very patient looking at technicals and see where I want to nibble on this here and there. And in terms of, because I linked it to the 2000 tech bubble burst, because you have you had the big guys, the big winners, Apple, Amazon, they were all bombing, carpet bombing, down 85, 90%. But they were the long-term winners, while the pets.coms and all those other things blew up, right?
Right.
And crypto to me is kind of the same kind of space. There's a lot of fluff in there. There's a lot of non-sustainable business models in there. They're probably all going to disappear, but there may be one or two long-term winners in there. So that's not for me to recommend to anyone. It's just my personal strategy, as I'm looking at this being under incredible pressure as well, also having a lot more downside risk if you go into a larger bear market. For us, it's literally being flexible. If you're not into shorting, which I don't recommend for most people, okay, shorting is not easy. Buying is easier. But to me, when you have big sell-offs, increase exposure. When you have big rip-offs, decrease exposure, right? It keeps building flexibility. Know where the points of confluence are, of support, right? Where it makes sense to be more aggressive. You should be less aggressive. There will come a time when all this sorts itself out, and then we do have a structural bottom in place. Was June a structural bottom? A lot of things will have to go right for that to be the case. And with monetary tightening still ahead of us in terms of restrictive policy, history at least tells us it's not a structural bottom yet. It may be a bottom for this year. Doesn't mean we can't roll over into 2023. And that's the other thing. People are really easily influenced psychology-wise, and I've been guilty of this myself, by what happens on a particular day or what happens in a particular week or two. Because price impacts sentiment, right? This is when you get people too negative on the downside, they call for new lows. And we're all influenced by this because we're hearing all this, right? You look at January, all these banks came out, 5,000, 5,100, 5,200, 5,300. These were all their price targets. Not one of them said 36.30.
Right.
Okay. Not one of them. And then when we got to 36.30, they were talking about 3,000. They did. Well, thanks. I mean, if you listen to this, you're just getting doubly screwed, right? But they're also human, and they're also part of the sentiment game, right? And so keep your own head on your own shoulders. That's why technicals are so great, because to help us, to tell us that, while we're at 4,800, it makes little sense to shout for 5,300 without something else happening first, which it did, right? So I like the strategy of being flexible to react and be more or less aggressive. We are pursuing a long short strategy. We're either net long or net short, and it depends on where we are with the signals. And then we just try to navigate these situations as best as possible. I'll just use an example. Sentiment is so important. I think I may have mentioned this earlier, but on Thursday, before the Powell meeting, the Powell speech at Jackson, Wells Fargo said he's going to be dovish, and there's going to be a relief rally. Goldman Sachs, he's going to be dovish. There's going to be a relief rally. Wrong, all of you guys. And people got literally caught with, maybe having bought the dip from the initial rejection that we just saw, and they got completely crushed. So the notion that there are, the insiders that really know where the next big move is, don't trust that either. I don't believe that for a second. That anyone can be wrong, including myself. Anyone can be wrong, right? And so sentiment is part of the gauge as well.
Yeah, well, and we talk about this a lot in this program. As individual investors, oftentimes it's our own emotions that can be our worst enemy towards building long-term wealth. So, as you know, Sven, on this program, we highly recommend that people work in accordance with professional advisors to take a lot of the emotion out of it, right? To come up with a plan, a position position sizing, strategies, as you said, if they're ripping, sell down, if they're dropping extremely, but the thesis still looks in play, then add, that type of thing. So they take a lot of the emotion out of the decision making. And then, specialists like yourself, on the technical side, where you're looking at the data as a way to sort of balance all the sentiment that's being shouted at us from the headlines, and just saying, okay, yeah, everyone's expecting that the S&P is going to go to a new high here, but man, things just look so overbought here. This doesn't seem to be the time to go all in on that prediction if things are at this kind of extreme. So again, I just want to underscore our continued advice there, that if you're an average investor who doesn't have years of experience doing all of this stuff on your own, leverage the expertise of experts so that they can minimize the whipsaw that your emotions are highly likely to do. Hey, real quick on a couple of go ahead.
Yeah, the old Isaac Newton story, right? I mean, just
with this
kind of an
bubble?
example. You can be the smartest person on the planet, and bad things can happen to you if you're caught in sentiment. Isaac Newton was arguably probably one of the smartest people to ever live. I mean, he invented calculus, everything else, right? Motion of the stars. But he got caught up in the South Sea bubble. He was in, the bubble went up, he made a lot of money, and then he sold and he was happy with himself. But guess what? The stock kept going up and up and up. All his friends were making money, and then he couldn't take it any longer. And he bought back in again, right at the top, and got completely crushed and went bankrupt. So, but what was the saying? I can calculate the motion of the stars, but not the madness of people.
That's exactly it. I can calculate the motion of heavenly bodies, but not the
Heavenly
madness of
bodies,
people. I
that's
pulled
right,
it up
yes.
as you were mentioning it. Yeah.
So,
Yeah, and that's a great cautionary tale. If one of the very smartest men in human history can be duped by his emotions the same way we can, we shouldn't try. So real quick on a couple of assets, two assets. One, given the uncertainty right now and the fact that we can make a pretty good argument that things could go lower in the future, do you think that cash is a wise position to hold as at least some percentage of your portfolio here? And I'll ask my second question too, and you can address both. Volatility. There are instruments to invest in volatility. This is a much more volatile market than we've had in the past. Are you playing volatility anymore? Actual volatility VIX-based instruments anymore in this environment?
So answer your second question first. No, I think they all suck.
Okay.
They really do. I mean, oh my God. Yes, there's VIX futures and there's horrible products like VXX. Stay away.
Because they just don't track well.
They don't track well. They are almost designed to make anyone lose money. Yeah, you can make money if you're exactly at the right time. But volatility has a way of compressing. As you may well know from past experience with us, we chart the VIX. Technically, there's still some holdouts out there. I think you cannot chart the VIX. You can. It's actually incredibly precise still to this day. And the pattern VIX goes through multiple patterns on a regular basis. The most common one are compression patterns that can frustrate, but they can be so clean. Because look, at the end of the day, it's all about algorithmic trading, and they all respect certain structures and formations as well. And like the summer rally, we had this beautiful compression pattern. It held the top line on the way down and held the bottom line on the all the way down, and it kept respecting it, and it was telling us a volatility spike was coming, and it has so far. And one thing about the VIX that has me generally worried is that we're looking at long-term structures on the VIX, and nothing is confirmed until it's confirmed, but the potential is there that we're going to see something really nasty happening in the VIX into 23. That would be kind of the recession, everything is right sizing type scenario. Notice that the VIX has not managed to stay below 20 this year at all. In fact, every time it got below 20 this year, this was kind of the point where it kind of spikes up again. I mean, if you have a true bull market, you want the VIX to not only go below 20, but stay below 20 and then drip into the 15s, 13s. That's your classic bull market compression pattern that we saw like 2017 to 2018 and so forth. But at this stage, it hasn't done it yet. Now, speaking just about the here and now, just what I'm seeing now, we just had 3 gap ups on the VIX. All VIX gaps fill. That tells me ultimately we're going to still have a counter rally coming here, maybe into early September. Note September 7th, we have the Apple an iPhone 14 announcement. We have Labor Day coming, so maybe that gives an opportunity to see some more volatility compression. I think the real event that's ahead of us is going to come past September 7th into the end of September, October. It depends on what happens with these inflation reports and the actual Fed meeting and so forth. And by the way, VIX gaps in general is just absolutely fascinating to watch, because whenever there's open gaps, literally they all fill at some point. They all fill. There's still one at 45 that hasn't filled, but we'll see about that one. But yeah, we saw this just now with the rally that was here from mid-June. While we were long, we were loving it. Yeah, there were 7, 8 open gaps on the S&P. It was just too much. At some point the market wants rebalancing, and we just saw some of these gaps fill, right? And there's still lower gaps as well, right? So that's part of kind of the technical toolkit, if you will, if things get too optimistic or too pessimistic in either direction. So you got to be mindful of that. But yeah, volatility tells me it's not over at all.
Okay. So because you track VIX so closely and it coils, right? It has these wedges it trades into that you expect at some point it's going to break out of. When that happens, given how you're looking at this, where you think there's a high likelihood that it's going to break up to the upside, if you're not trading in some of these VIX instruments, how do you play that? Do you play that just using the indices?
Yeah, absolutely. And the fact we use the VIX particularly to help us also identify when to, for example, scale out of shorts. When I see a VIX gap fill, like let's say there's a VIX gap up. Let's say, for argument's sake, there's a VIX gap at 30, and the VIX hits it. That tells me I'm definitely taking the shorts down. Now, can it spike above? Absolutely. But it may also, if everything else lines up, it may be also a pivot point to buy. Because every time I see this, when VIX gaps fill, they tend to act as a pivot in the market. It's literally, it's a signal tool, right? And if I now say, okay, markets are in carnage, and I'm looking at signals that signal a potential buy, and I see the VIX massively overbought, and I see it filling a key gap, for example, or even hit a key trend line. By the way, this was a really cool tool this year, which was counterintuitive. As I mentioned earlier, when the S&P kept making new lows, the VIX kept making lower highs. That was confounding a lot of people. But it was this lower trend line, and it kept tagging it, and every time it was a buy on the market, right? So there is that relationship that we look at closely. And at this point, we can say, well, so far this year has been unusual, because for a true bear market, you would typically see a much higher VIX spike. It's been all very suspiciously orderly so far this year in that sense.
And when you say suspiciously orderly, are you thinking potentially that somebody's buying in the market here to try to keep it orderly?
I don't have my tinfoil hat with me, and I don't want to wear one. But in context of what happened in the first half of the year, the VIX made, in terms of making lower highs, it was very unusual. The entire correction was very orderly. I didn't have any sense of panic at any moment at all. I mean, for a true bottom, typically you want everybody puking into protection,
right?
Typically. And maybe that goes back to the Bank of America chart. Maybe the VIX is just that, maybe there's no conspiracy here. Maybe it's just simply a reflection that people are still conditioned that the Fed will relent and bail them out, because they didn't sell, because equity allocations remain historically high. Okay. And so maybe the reason there was no fear is because there was no fear.
Right. And a lot of market veterans, like folks with grayer hair than you and I, tell me that that's how they know if we're in a bear market that it's not over, because they say by the time a bear market is over, like nobody wants to touch a stock with a 10-foot pole. And we're just not seeing that kind of capitulation and destroyed confidence in equities right now.
I think I called it the 5 stage of bear market the other day, using the 5 stages of grief,
Agreed.
you know,
Okay. Yeah.
denial, anger, bargaining, depression, and acceptance. I don't know if we're in denial yet, stage 1, or in the bargaining stage at this point, right? But we haven't had the depression part yet at all.
We haven't. And I've mentioned this relatively recently. You know, 2 months ago, people were in the bargaining phase, right? Of like, oh God, please, just if this just recovers a bit, then I'll sell out. Just let me get out from being so underwater. People have kind of had that gift, right? The markets have bounced enough that if you were sitting on some big losses, you know, you've recouped a good deal with them. So if you think that the market could roll over again from here, like if you were bargaining 2 months ago, you should be lightening up on those positions now.
But then what happens is people begging for a rally to sell out, and then the rally comes and they go, the worst is over, and then they're going to add more again.
Yeah, they flip back. Exactly. Yeah. Back to our emotions being our absolute worst enemies here.
Called trading backwards.
Yeah. So I interrupted you real quick. Just cash, your 30 seconds view on it.
Yeah, always have flexibility. I mean, you know, it especially on big rallies, create flexibility. So when there are dips that you think are viable, then have that flexibility. Why not be active? I'm not saying be out of the market completely at all. You know, have toes in the finger, but be aware of shifting risk reward. That's a challenge for everybody. Now you can say, okay, well, I have a 20-year time horizon. I don't care what happens if we drop 30%. Fine. You know, I'm too old for 30-year time horizons. You know, and again, if there is no structural bear market and we're coming through this out somehow, then you know, none of what I say now makes probably a lot of sense. And if you can take the drawdown of another 10%, 15% down, that's fine. But if we are in a structural bear market, which to me is still a possibility, it's not been disproven, at least at this stage, then, you know, 30, 40, 50% drawdowns are going to hurt a lot, you know, in terms of opportunity costs. You know, so to me, the constant dance with risk reward being either more aggressive on the long side vis-a-vis less aggressive. Again, shorting, I'll leave that for those that really want to play that. I'm going to say this again, principally, shorting is hard. It takes a lot more patience and discipline to position for a short. Right. Whereas when you have, you know, flushes, you can be more aggressive, or you get more instantaneous results in many cases, right? But the notion to always have the flexibility to be able to react to something, and going into September, October in particular, I think that's a good thing to have. So if we get a bounce into early September, maybe it makes sense to allocate or to have some more flexibility on a downdraft. To
use that to raise some cash. Okay, great. Yeah. All right. Well, look, Sven, thanks for giving us so much of your time today. I always love talking with you. You're one of my favorite guys to interview. And here's why I'm going to ask this next question, which is, you know, I follow you a lot on Twitter. We have these great conversations here, and you seem to be a man who appreciates the aspects of wealth and life that go beyond just the financial. Family, fitness, keeping a really resilient and beautiful homestead, taking interesting travel, having interesting experiences in life. So I'm just curious, like, could you just briefly sum up sort of your philosophy on what is true wealth in life, what's truly important? Because we spend so much time sort of stressing about the Fed and looking at the numbers on the screen, but you seem to be really good at saying, yeah, I mean, that money stuff's important, but it's not everything in life.
As an old phrase comes to mind, contentment is wealth. You know, if you're stressed about money, if that's your sole focus, you know, it's gonna eat you alive. You know, I mean, I've been poor before. I've been through, you know, I was not born with a silver spoon in my mouth, so I know exactly what it's like to struggle financially. So I had that focus. I was in the corporate world for a long time as well. Finally got myself out of that and just doing a completely independent thing that works well for me. I love markets. I love the challenge of markets. Keeps me mentally sharp. It's always a mental puzzle. We relocated a few years ago here into the English countryside, and I'm loving it. I'm having a blast out here. Everything from wood chopping, running, you name it. We're keeping a balance. And yes, travel, absolutely. COVID sucked, obviously, for all of us. We couldn't go anywhere, but I always love seeing places and change of scenery, and also being able to shut off from online. I think that's a big challenge for all of us. It's important for mental health to say, okay, now is enough. I don't need to be in every move. I don't need to follow every news story. I don't need to follow what someone says about me. I don't care. You got to have the risk is that we're spending way too much glued to screens in everything that we do. We're on screens for markets. We're on screens for entertainment. We're just sedentary all the time. And it's a dangerous path, slippery path to be on all the time. You saw Elon Musk yesterday. I don't know if you saw this. It's kind of funny. He got a lot of grief because he was photographed on a boat in Greece this summer. Having probably added
looking a little heavy
pounds. Yeah. And I've kind of done the same thing myself during COVID. It really frustrated me. So I've kind of been on a intermittent fasting type regime and getting fit again and all that. And last night I was online and I just saw him tweeting about it, that he started pursuing some sort of fasting app, and I just made an offhand comment, asking him how much he's lost, and he actually responded.
Oh, really? Congrats.
He did. I was talking about maybe doing 800 calories a day and how the cravings go away and how much has he lost, and he responded. He says, "I lost 20 pounds." So it was funny because it's a challenge even for the richest man on the planet.
Yeah.
Right. Who is massively involved in multiple companies and lawsuits right now, and it's not healthy for him either. Right. And I think he's recognized it, and he's doing something about it. So I think that's keeping a right balance in life, I think, is an ongoing challenge for all of us.
Yeah, balance. I think that's really one of the things that I respect most about you, Sven, is you seem to keep a really good balance. And it's I love hearing your parts about disconnecting from, all our devices and whatnot. You do a really good job of that because you are very active in social media, in digital media with, all your charts and all your observations and whatnot, but you do a really good job of somehow being able to just flick that switch off and then go focus on the rest of your life. So it's a good example you're setting for the rest of us. All right, well, look, I guess since we're talking about social media and websites, for folks that have really enjoyed getting to know you through this conversation and would like to follow you and your work from here, where should they go?
Well, my Twitter handle is @NorthmanTrader, which is also the website, northmantrader.com. I also have a little Northcast that I call, Northcast. It's part of my Twitter profile. It's where I try to put out occasional videos just explaining some charts and what I see. We have a subscription service that's more focused on the actual actionable activities in markets, either long, short. It's called the Daily Market Brief and live action alerts. So you can see that on the website if you like. We also have market videos that I put out 2-3 times a month, which kind of gives a broader perspective, strategy-wise, what's happening on the macro and on the technical front in markets. So never a dull moment.
All right, great. And when we edit this video, Sven, we'll put up the links there to the website and to your Twitter handle. Well, look, Sven, can't thank you enough for giving us so much time. Folks, a reminder, we're continuing our new practice of me recording my takeaways from these key videos. So if you want to get mine from this discussion with Sven, just go to wealthion.com/AdamsNotes. All right, Sven, thanks so much for giving us so much of your time. Look forward to having you again on the channel, maybe later this year after we see what the fall has brought us in terms of some of these, volatile curveballs that you're thinking it might. But just, it's always great, buddy. Thanks so much for joining.
You bet. Thanks. Great having time with you, Adam. It's been a while, so looking forward to the next time as well. Take care.
Right. All right. Well, now's the time in the program where we bring in the lead partners from New Harbor Financial. They're one of the endorsed financial advisors by Wealthion. I'm joined here by senior partners John Lodra and Mike Preston. Guys, great to see you again. Another great conversation with Sven. He's always just fascinating to talk to. Very curious to hear your guys' takeaways. John, since you were away last week, I'll let you start here. What did you take away from Sven?
Hi, Adam. Great to be back. Yeah, Adam, we really enjoy Sven. Mike and I do follow his content pretty religiously, among many others. He is, by his own admission, very much a index trader, which has his place and is certainly more short-term focused in style. But Sven, I think, has driven home a common theme that we have been talking about time and time again. We realize it sounds kind of like a broken record, but it is what it is. And many of your guests speak to this. And it's just the broad context of the paradigm that we've been in, the regime that we've been in with central bank policy over the last decade, with a very focused intent by central bankers to, by manipulation, essentially, drive asset prices up to unnaturally high levels. And Sven spoke of, and we agree with him, basically a paradigm shift, and many of your guests agree with us, and we're finally getting Fed folks to come out with very strong language themselves, realizing that they need to start talking back, and not only just talking back, but acting to reverse much of the policies of the last decade. Sven talked about how the quantitative easing basically increased tenfold over the last decade, and even in 2020 alone was up about 75%. But even in 2016 and through 2018, when the Fed started to tighten, it was not really tightening because the rest of the world was loosening, right? So it was still an expansionary monetary system. We're now in a phase where most central banks are being forced to tighten, with the exception of places like China, who's been relatively increasingly accommodative. But the rest of the world is tightening on a relative basis. And that's because inflation is now the boogeyman that has finally shown up on the scene. And it's really getting serious. I just read a quote today about, we talked about how the housing market's starting to weaken, but it's still, house prices are still higher than where they were pre-pandemic. And they were inflated then. Rents, I looked at a stat for rents. They were $1,623 prior to the pandemic per month. In August 2021, $1,830 a month average rent. They got as high as, they're now $2,030 a month. This is from a Zillow rent index. So inflation is becoming a really bad problem for everyday folks who don't own assets and are the price of living. So there's a reason why Jay Powell spooked the markets last week by using the word pain, because he realized that we think that the market has been not taking them seriously enough in terms of what they need to do to address this inflation problem. Just today, the Fed's Mester came out and said, if you think, basically she is projecting that we're going to need policy rates of about 4% through 2023. We're now at 2.25. I think the 2.3 is the target rate. So there's yet further increases baked into her mind anyways, and that there will be, very little chance of a rate pivot all the way through 2023. So the Fed is really starting to talk very tough, and the markets are starting to reprice relative to that. And we've seen that, there have been a recent technical bounce in markets to some key technical levels that Sven spoke about. And at least in the last several days after the Fed speech at Jackson Hole, they come off pretty sharply off of those short-term technical resistance levels is what we think ultimately prove to be. So I'll just stop there. That's high-level takeaway of Sven's comments.
All right, great. And Mike, I'm coming over to you in a second, but just to build on what you just said there, John. So for a while on this program, we've been tracking the disconnect since the markets started rallying pretty hard after the June lows. And if you looked at the macro situation there really wasn't any good reason for them to be doing so, other than what Sven said, which is sometimes you just get so oversold in the short term that there has to be some sort of, short-term correction, some short-term relief rally. But if you looked at what the market was pricing in terms of interest rates, forward for the next year or so, it was pricing fewer rate cuts than what the Fed has been guiding, fewer rate hikes than what the Fed has been guiding, and actually projecting rate cuts starting next year, multiple rate cuts. So there's been this pretty wide disconnect between the guidance that the Fed is giving and what the market is anticipating. And sort of the market, I think, had been trying to call the Fed's bluff, saying, look, we don't think you guys are going to hike as much as you say you're going to. You've always pivoted in the past, when things began to get a little tough. And we think you're going to do the same here. And the Fed was saying, nope, we're serious this time for the reasons you mentioned, John. And so it was kind of this game of chicken. And it looks like the market is waking up to the fact that it might have lost that bluff, that the Fed is indeed proving to be more committed to hiking higher for longer. And the market now has to adjust for that. And since Powell, gave his terse, but I'm really serious speech on Friday, the market's done nothing but go down every day since. We're now below 4,000 on the S&P. So how material a milestone is that? Well, we'll find out pretty soon. But anyways, so it does seem that what you're saying, John, is I think everybody initially sort of believed and hoped, the Fed and the other officials, that inflation was going to be transitory. It wasn't. It's still being really stubbornly high, and now even the central bankers are walking back their initial positivity and saying, "Hey, this is a real problem. It's going to require pain to fix it," as you mentioned. Again, you were giving some stats of high real estate and rents and things like that here in the U.S. Man, if you're in Europe, you really understand that inflation is still not tamed. When you look at your energy bills, right? We're seeing stories of inflation costs. Energy costs going up by hundreds, or in some cases thousands of percent. You see stories of people getting electricity bills that are in the thousands, maybe over 10,000 euros per month. It's just bananas over there. So anyways, long story short, as you were saying, John, inflation has really changed the game. And as markets really accept that, for a whole bunch of reasons, mathematically, the odds are that they have to reprice downwards. And the question is going to be, okay, how much further downwards? All right, enough from me. Mike, what did you take away?
Yeah, just a couple more things I'll add. There's a lot of talk about the Fed, like usual, because the Fed is the name of the game. It has been for a long time, 14 long years, I think. The Fed has caused conditioned behavior. They have coddled markets. They've rushed in at every little crisis. Actually, I wouldn't even say that a crisis has even been able to develop. And so it's caused this conditioned behavior and, frankly, zombification of the economy. That seems to maybe be changing now. I hope it is, because yes, we do need some pain to try to get some reform eventually in this central banking regime. So it's a very dangerous situation. Sven talked about the 5 stages of grief: denial, anger, bargaining, depression, and acceptance. In my opinion, we haven't even crossed through denial yet. And John and I have been in this business for a long time. I started in the late 90s and certainly saw the tech bubble, then the housing bubble, now this. And thinking back to my time during tech bubble, you could see palpably each of those 5 stages. We haven't even crossed through the first stage yet, in my opinion. And the decline that we saw so far this year has been suspiciously orderly, to use Sven's words. Absolutely suspiciously orderly. There's been no panic. Yes, there were some sentiment figures that were kind of skewed to the bearish side a few months ago in June, but really to taking a look at what people were actually doing, like Sven pointed out again, the equity allocation was in the mid to high 60s. I think he said 64%. I think I saw a chart that said 67%, even at the low 36.30 back in June. So what people are actually doing, what investors are actually doing, was staying put. And so far that's worked. But we still think that we're in a bear market rally. Sven said that he it's possible we're in a bear market rally. I guess we won't know for sure until those June lows are taken out to the downside. But, since Powell talked last Friday, mentioned the word pain, the market has tried to rally each morning the last couple of days. The market's been up in the futures and up at the open, and then has rolled over. To me, it looks like we're wanting to accelerate to the downside here in the near term. We will see. But we're still at levels at around 4,000 on the S&P. Still a great time to lighten up if you haven't done so. I can tell you from personal conversations that over the last few weeks, a number of people felt more confident about holding on and said, well, maybe I'll just wait for one more move higher, then I'll sell because I'll be closer to that recent peak. I wouldn't do it. I would lighten up right here if you haven't already done it. And so we're looking for lower lows here in the near term, and hopefully opportunities to buy as well when that happens.
Okay, so let's talk about the actual, how do you invest in this type of environment? And Sven said, hey, this is a great environment for me because he's a trader, because he said there's just a ton of volatility now that wasn't in the markets much over the past real decade, really. Pandemic removed. But he said in this environment, you need to be perma-flexible, right? That any one particular strategy is probably not going to safely navigate you from one side of this era to the other, because there's going to be so much volatility in there that if you don't react intelligently to what's happening on the ground, you might get killed along the way before your main thesis is potentially proven right at the end. So if you're managing capital in that type of environment, first off, I think he gave you guys maybe kind of a nice little commercial there, which is it really is a vote for active management, right? You can't just have a set it and forget it strategy, which worked pretty well for the past decade as all boats were rising. You could be long and just not think about it, and you do pretty well. Now I think we're in a very different world. And Sven, my takeaway from his commentary was that the odds are likely to the downside with these markets. The bear market's not quite over yet, but he said, hey, he could easily see a scenario where for the next couple years, we're just sort of stuck in chop, right? Where it's going up, it's going down, it's going up, it's going down. And, that can be a challenging time to make money, again, especially if you're just trying to pick one strategy. But also there's lots of opportunity to make money in that volatility if you are, watching closely. And have some experience and have some rules in place that help you hopefully buy low and sell high as you're going through those ups and downs. Of course, that type of environment tends to be almost the worst type of environment for the regular investor because of the emotional factor, which Sven and I talked about, where your emotions get in the way. They oftentimes force us to make the wrong decision at the wrong time. An example being, in a volatile market, when the price really starts going up, everybody thinks, okay, well, this is it. We're off to a new high, and everybody jumps in, and then you get the reversal. And so what happens over time is people keep buying high, right? Which is the exact opposite of the buy low, sell high that you want to go through. So, John, coming back to you as money managers, stewards of people's capital, how are you guys looking at investing in this coming era?
Adam, we totally agree with Sven's emphasis on the importance of flexibility, especially in the environment we're in now, with so many cross currents and so many structural likely shifts. And one of the key reasons for that, we need to kind of bring, I think, some transparency back to where we truly are in terms of the markets. Forgetting about the Fed, drug pushing for a moment. Look at where markets are priced. Sven talked about some valuation metrics, and most folks can logically or intuitively understand that the stock market should have some tethering of valuation to the underlying economy. So one of the very common metrics for valuation that folks might speak of, and this is the famed Warren Buffett indicator, is the market cap or the value of the stock market relative to GDP. And Sven gave us some convenient reminders of what those levels have been in major episodes of history. The tech bubble, that market cap to GDP peaked out at somewhere in the 150s. Okay. And when the tech bubble popped, it dropped into the 70s. Okay. Housing bubble, that metric got to 137, 140% of GDP. And when that popped, it went all the way down to 55% or so of GDP. So the ratio of market cap to GDP was well below 1 to 1. The recent highs last year before this year, that metric got up to over 200%. Never before, not 1929, not the tech bubble, never before have we seen valuations that untethered or that inflated relative to GDP.
Right. Never before and not even close. Right.
Not even close. Not even close. So we cannot lose sight of that, okay? Because the idea of being flexible and trying to clip coupons on these short-term technical moves is all well and good, but you always have to factor in some consequence that you won't get that right. And what is the magnitude of the consequence? So the position size really needs to be taken into account. If you're going to do some short-term trading of these technical bounces that may likely play out in a structural bear market, you certainly don't want to do it with 100% of your money. And especially at these lofty heights, we would say it should be all that much smaller of a wager that one is willing to make. But even at the June low of this year, that ratio only got down to 155%, right where it was at the peak of the tech bubble. So we haven't, even though we were in a technical bear market, we had a bear market to what then was one of the most overvalued levels of all of history. So that is important, really important for folks to remember. Oftentimes Wall Street strategists would like to talk about forward PEs, basically their projections for the earnings in the S&P for next year. And right now, the forward PE for the S&P 500 is 18.8, I think, times forward projected earnings. Now, forgetting for a moment that we are still in record margins, and forgetting for a moment, as Sven reminded us, that the analyst earnings have nothing priced in there for a possible recession. So if a recession does happen, those earnings estimates are wildly inflated to begin with. But the norm, John Hussman did some great work in his latest monthly piece, and actually went back and said, okay, if we're going to use this kind of one of the worst metrics of PE that one can think of is the forward operating PE. And there's a reason for that, because it's not very reliable unless you correlate it to some other things. He said, if we're going to use that, let's go back and define what the norm has been for that. And you can go back to 1900 as he did and impute what that, and the norm is like about 11, right? So if we're at 18.8 and we're going to 11, that's a 40% drop from here. And ironically, that's roughly about the same. If Sven said, even if we only pull back to 100% of GDP on the market cap, which is still way higher than it was in any bear market bottom, that's another 40% down from here. So just really important for folks to not lose sight of how inflated things still are at a time when the punch bowl is likely being yanked away in a very profound way.
Yeah, and it's interesting that number 40% is coming up again and again in a number of the interviews that I've done here recently. I know that that's what Michael Pinto was sort of estimating. Jesse Felder was 40 to 50%. There's one or two others that I've interviewed in the past just 2 weeks alone between those two guys and now. That we're coming up in the same sort of 40% range. Look, nobody knows exactly what's going to happen, folks, but I think that the experts on this channel, at least, are making a pretty good argument that it's certainly in the realm of possibility, and probably getting close to a probability that we should all, be worried enough about to be taking defensive steps against. All right, well, Mike, look, as we begin to wrap up here, one of the things that Sven and I touched on at the very end here was the human cost of, we rant about the Fed policy and whatnot, and we do all that, not because we just like to be wonks and be one of the few people, in society that actually tracks the Fed and talks about this type of stuff. We do it because we're worried about the human cost that poor policy results in. And I just gave some examples about what's happening in Europe right now, where people really are at the point where they're like, look, I either pay my energy bill or I eat. That's my choice this month. And of course, this is still August. and folks are watching this, it'll probably be early September. But we're not even in winter yet, right? Which is when things are going to get really, really tight and challenging there. Just the inflation that we're seeing, at the end of the day, that is the loss of purchasing power, basically largely due to bad monetary policy. Sure, there's some supply chain issues that are still complicating things, but that's largely all due to decisions that were made on the monetary and the fiscal policy side. So, it results in real damage, real harm to real people. And at the end of the day, that's why we're so focused on doing what we do on this channel, is to try to help educate people so that they can take prudent steps in advance of what might be coming, so that they can be better protected from these things. So anyways, I know you talk to people all day long there. I know that you guys, live and breathe, how do we be good stewards of our clients' capital? I'm just curious if you've got any sort of parting thoughts on, how we can best sort of serve people's interests here in trying to get them ahead of the worst of what might be coming.
Yeah, it's tough. It kind of goes back to the corrupt policies that we have with the central banks. We've just created an insane concentration of wealth these past 14 plus years. Using Sven's words, the rich got insanely rich, inflation ran wild, and now the poor are going to get crushed. That's the problem with these policies. And Sven said that the younger generation is basically hoping and praying for a housing crash. I think he's right. John talked about the increases in rents, which basically went parabolic post-pandemic. We haven't even gotten back to where we were in 2020. So yeah, we're gonna need some pain. We're gonna need some type of collapse. And I think that the numbers that were just shared are relatively conservative. Nobody can predict the future, and everyone's basically shy to do so because nobody wants to seem too extreme. But a 50% decline from here would be completely run of the mill, and something much more could easily happen, 60, 70% plus. So you can't print wealth, you can transfer wealth. And this is what happened. The Fed has kept the pedal to the metal for far too long. Like Sven said, they should have stopped when we had record fiscal stimulus post-pandemic, but they didn't. They just kept going and going and going. And so now we have what I believe is the largest wealth disparity we've ever seen. And the bottom, let's say 40%, really didn't take that ride at all. And now they're stuck with higher prices, and this is causing problems. Almost everyone can see it now in the grocery store. Packages are getting smaller, prices are going up. And so what do you do? Your question to me was, what do you do to be resilient? Well, I think that you're conservative with the investments that you do have. If you have them, you get as conservative as you can be. Simplify your life. It's not easy if you're already kind of on the bottom end of things, but certainly postpone purchases if you can. Try to save up a little bit of cash. Have some gold and silver in case we get real crisis and hyperinflation. Try to be as resilient as possible. Nobody knows how this is really going to unfold. It should really unfold in a crisis bigger than we even think could happen, because it's just that extreme. Doesn't feel like it, but it is. And so simplify, reduce, reduce risk when you can, and focus on what's really important in life, relationships and fun things to do. That's my best advice.
Yeah, no, that's great advice. And Sven and I talked a little bit about that at the end, which is, really keeping your eye on the ball and what really matters in life with wealth. And look, we're here to help you be the best stewards you can be with your financial wealth, but it's only part of the picture, right? And if we see the type of recession that we think may be coming ahead, even despite many people's best efforts, you might be working for a company that goes under or whatever, there may be layoffs, there may be times where the money is not coming there exactly the way that you want, and you don't want that to be your only source of fulfillment and happiness in life. You want to have a rich life so that if the money part isn't exactly where you want, you're still, living as richly as you can. All right. Well, look, you when you were talking there, Mike, you made me think of a chart that I'll put up right here that shows that it basically shows the cash balances of various different households by income, I think, or income or net worth by income. And it shows that for the most wealthy, the folks making the most money, they just got the lion's share of the increase in savings, as a result of all the crazy monetary and fiscal policy unleashed after the pandemic. When you look at the under 50,000 cohort, which is the lowest cohort, like it's barely budged. So it's a really good visual that, yes, we did a ton of emergency measures to try to help everybody throughout that, but it very, very disproportionately favored the upper end of the wealth spectrum. So anyways, that's why it makes, I think, if you're not a Rockefeller, the takeaway from that is what we advise on this program, week in and week out, which is partner up with a good financial advisor that understands all of these big macro issues and can help you, A, put together a plan for navigating what's coming ahead, and B, kind of be your guide and your quarterback through it, especially if we're entering this very volatile, high chop era that Sven thinks could be coming. And the key part of that is to leverage their expertise, but to also leverage their counsel when your emotions, begin to take control of you, where they can be the voice of reason that can maybe stop you from making rash decisions based upon your emotion, and saying, hey, look, what does the plan say? Is there a reason to change the plan? If not, all right, let's just stick with the plan, because that can be a huge game changer in terms of saving, yourself from making some really bad decisions. So anyways, if you have a great advisor like that, excellent, stick with them. If you don't, then recommend that you try chatting with one of the endorsed financial advisors from Wealthion here. It's totally free. There's no commitment to work with them. It's just offered as a public service. You could even chat with Mike and John here if you like. Just go to wealthion.com and fill out the short form there. Also, just a reminder for folks in terms of navigating what's ahead, that is the main focus of Wealthion's fall conference, which is coming up pretty quickly now. I think it's only about 3 weeks or so away. It's September 24th. And just want to make sure, because if you're watching this video, the day this is going to be released, you'll only have about 24 hours to register at the early bird price. That expires on midnight this Saturday. So if you are watching this and haven't registered yet and are interested in the conference, go very quickly to wealthion.com/conference and lock in that early bird discount. It's around 30% or so. So it's definitely a savings you want to lock in if you can. Just a quick reminder for folks that haven't seen it, we've got speakers there like former Fed senior economist Lacey Hunt, Lynn Alden, Matt Taibbi, the award-winning journalist. We've got Grant Williams and Stephanie Pomboy. We've got Alf Peccatiello. We've got Doomberg talking about energy. We've got Nick Jurley talking about the housing market. We've got Rick Rule talking about hard assets, Mike Maloney talking about precious metals, Jeff Clark talking about the mining stocks. We're going to have Mike and John there all day, and they'll be fielding your questions. No question too big or too small in terms of whatever financial questions about your own life you'd like answered. It's going to be a phenomenal time, folks. So if you haven't signed up for that conference, like I said, do so quickly so you can lock in that special price. All right, and if you enjoyed having Sven on this program, would like to see him on again and other great guests of his caliber, please do me a favor and support this channel by hitting the like button and then clicking on the red subscribe button below, as well as that little bell icon right next to it. John and Mike, thanks for joining me for yet another week and giving such great counsel. Whatever happens from here, guys, we will be meeting again next week to make sense of it all for folks. Everybody else, thanks so much for watching us.
Hey, Adam, before saying goodbye, I want to give you one other plug. I had the opportunity to look at the video you did with Mary Beth Franklin yesterday on Social Security. Just so happens I have a conversation with a client on that today, and we do counsel our clients often on these kinds of things. These are the kinds of planning things you can do and have a lot of control over. It was great. It was a great reminder what I know, and she's certainly a wealth of knowledge on the basics of Social Security. So I encourage you viewers to watch that.
Hey, I appreciate that. And folks, I'll put up a link to that here if we haven't watched it. I appreciate you mentioning that, John, because I did think it was a great discussion. In fact, it was a much more interesting discussion than I even expected it to be when I invited Mary Beth on the program. And there's a lot of, nuance to Social Security. There's a lot of things there that I didn't realize that you need to take into account. And so if you're on Social Security, obviously watch it. But honestly, I think if you have yet to get to Social Security age, you need to watch that video even more, because there's a lot of important decisions that you need to make once you start hitting that 62 years of age milestone. And depending upon what decision you make, it can add up to a lot of money in terms of the differential over the course of your retirement or your later years in life. So yeah, and very interesting too. Who knew that Social Security could be such an interesting subject? So anyways, I appreciate that. Mike, I'll let you have the last word.
Just want to say thank you. I enjoyed it like we do every week, and we'll talk again with you soon.
If you'd like to schedule a consultation with one of the financial advisors at New Harbor Financial, simply go to Wealthion.com. These consultations are completely free, and there are no strings attached. The good folks at New Harbor will simply answer any questions you have about your investment goals or your portfolio and give you their best advice given their latest market outlook. They're willing to do this because they care about protecting people's wealth, and because Wealthion has connected them with so many thoughtful investors just like you over the past decade. We started doing this because so many people have approached us in frustration, looking for a solution because they're feeling out of alignment or downright ridiculed by the standard financial advisors who have been managing their money. You know the type. The kind that just pushes all of your money into the market, scoffs at the idea of owning gold, and when you bring up concerns about the market's sky-high valuations, they say, "Don't worry, the market will always take care of you." For many of the reasons discussed in today's video, we think this is one of the most challenging and treacherous times in history for investing. We strongly believe that today's investors are best served working in partnership with a conscientious professional financial advisor who understands the risks in play. Now, we're agnostic which professional advisor you work with, as long as they're good. If you're already working with one, that's fantastic. Stick with them. But if you don't, or are having trouble finding one you respect or trust, then consider talking to John and Mike and the team at New Harbor. Now, for those about to ask, yes, there's a business relationship between Wealthion and New Harbor, which we've put in place to make sure everything is handled according to SEC regulations. All the details on this are clearly provided on the Wealthion.com website. Also, it's important to note that New Harbor is able to work with U.S. citizens, green card holders, and those with existing assets in the USA. But for regulatory reasons, they aren't able to take on non-U.S. clients. All right, with all that said, if you'd like some insight and guidance on how to protect your wealth during this unprecedented time in the markets, go to Wealthion.com to schedule your free consultation with the good folks at New Harbor. Thanks for watching.